For this masterclass panel session, our moderator is Amy Ellis. Thank you, Amy Ellis. She's a partner at PwC, New Zealand. She has more than 20 years experience in commercial and banking area, specializing in merger and acquisition, as well as focusing on privately owned companies. Amy, the panel is for you.
Thank you very much. Thanks for the introduction. As Francois has said, I am a partner at the corporate finance practice of PwC. I think the reason I've been invited here today is that we specialise at PwC in mid-market mergers and acquisitions, and that's certainly what I've spent most of my career doing the last 10 or 15 years. And in that world, in that deal flow, in that mid-market, private equity is, I don't know if I want to use the word dominant, but certainly a key feature. So more, whether it's sort of as clients or potential buyers, we are seeing private equity in most of our transactions, which is great. It's been a lot of fun working with private equity and working with some of these guys over the last 10 years. So it's great to be part of the panel. Thank you for inviting me. My sense is that private equity, because of the nature of the work that they do, being pretty closely held in the small community that actually operates in the New Zealand sector here, is probably not that well understood from the outside. It's probably has a reputation of being a little exciting and intriguing, but perhaps not that open and transparent from the outside. So I think it's fantastic we've got such an experienced panel here today to share some insights and learnings with you. We have this fantastic device. We're really hoping that this will be an interactive discussion. Please submit lots of questions. I have a few, but don't rely on my questions. I'm sure you've got lots of better questions, so start sending them through as quickly as you can. Look, first things first, some introductions. Look, we've got three fantastic experts on private equity sitting next to me. First here on my left is Ross. Ross is probably well known to many of you. He is the Managing Director of DIRECTCAPITAL. DIRECTCAPITAL is one of our earliest private equity funds here in New Zealand, and Ross has been in the sector since 1985, first in Hong Kong, and then came back to New Zealand in 1994 to establish DIRECTCAPITAL with two partners. And over the course of that period, DIRECTCAPITAL has invested $1.2 billion in private capital into the local markets, which is just a fantastic achievement, and is currently investing their fifth fund, which is a $375 million fund. So it's great to have Ross here. Nigel is sitting next to Ross, and Nigel is a managing partner of Pencarrow Private Equity. So Pencarrow is as long-standing in the New Zealand market as DIRECTCAPITAL. I think the first fund, Nigel, was raised in 1993. That was a $25 million fund back then, which would have been a pretty notable fund at that time. But what's even more notable is that 25 years on, they've just raised their fifth fund, which is a $250 million fund. So unlike the sort of little brother discussion we had in VC, we're facing lots of challenges, this sector here in New Zealand has really grown and flourished over the last couple of decades. And finally, down the end, last but certainly not least, we've got Dave Weavers. He's a banking and finance partner at Russell McVeagh, and he brings a really unique perspective to this discussion because he's specialised in the financing structures for private equity transactions. So he's seen and been part of a lot of transactions here in London and I believe in Hong Kong. So it's great to have his perspective in this discussion as well. So look, it's great to see some questions coming through, but I'll start off with one of mine. And this is for both you, Ross, and you, Nigel. Observing that you've been involved in this sector for a long time suggests to me it's been a lot of fun. I'm interested to hear what initially drew you into private equity when it was just in its infancy and not well known in New Zealand, and what changes you've seen over that period. Maybe you, Ross? Or...
Okay. All right. Well, thank you, Amy, and thanks for having us. I got into private equity I was a professional. I was involved in insolvency, and I was in Hong Kong at the time, and it was booming. So people in insolvency were being moved into other divisions, and by stroke, I was just a junior at that stage, and I got put into what was called the direct investment team at the time, advising all the funds around Asia. And So I saw it and I liked it and I joined it, and that was what people were doing then. But the one thing I did remember about it was I remember meeting all of the investors, most of whom in the funds we had to deal with came from outside of Asia, and I saw the returns that they were making in this area, and I thought it was an intriguing thing. And look, half the time when you're trying to raise money, you just have to prove that you can make money. You know, the superannuation funds aren't there for a good time or diversity and investment. They're there to make money. And then when you're away, everyone decides they'll come back at some stage, and the need for private equity was clear here, we thought, and that thesis has drawn out for both of us. But I think the main thing I saw as well as and liked about it is it's not a finance game. It's people who join it are people, and that's an important part of the business for both of our funds. And so the financial skills are a given, and it's getting on with people and then running a business. You spend a short time investing in one, and a long time being in a business that's just being run. So you get the best of both worlds.
Yeah, so I've got a different track into it from Ross. Ross has been in it for a little bit longer than I have. I spent nearly 20 years doing similar to what Amy's doing as an investment banker. I came into investment banking at the time of the start of the privatisation wave. I was involved in a number of transactions there. That then turned into more general mergers and acquisitions. And then more latterly in my investment banking career, I saw a lot of private equity funds beginning to get interested in the sector, and we were involved either on the buy side or sell side with private equity funds, and that kind of got me really interested. The one thing about investment banking is actually a very good route as a career into private equity, but the one thing about investment banking is very transactional. Whereas, as Ross was saying, when you go into these private companies, work with the individuals, it's very transforming. So you do the transaction, obviously, but you get to live with the companies as well. And I think that's the beauty of what we do. And as Ross was saying, it's as much working with the people and the strategies and where the business is trying to go as much as the numbers, but albeit the numbers are important as well.
Thanks. Dave, just interested in your perspective. I'm sure you've seen the same thing that I've seen in our market as advisors, private equity becoming an increasing feature over the last decade and taking over a big chunk of our workload. Interested in your perspective on that, what might be driving that?
I guess the returns drive the money to the asset class, and then the success, the success of those investments then drives more returns and more money raised, and you've got some great funds in New Zealand, and the industry has really matured. We've got sort of two of the most sort of long run funds here in New Zealand, but there are a few others as well, and the asset class has really grown.
Thanks. Thank you so much for all the questions coming through. I'm going to jump to those shortly. One question that I have listening to Cecilia's talk this morning, which I'm sure we all really enjoyed, she said a very strong theme around sustainability and raised the Sustainable Development Goals that the UN has set and the concept of an ecological ceiling to match the sort of economic objectives that we've often thought about when we're thinking about growth investments in business generally. Interested, Ross and Nigel, how you are seeing that and how you're deploying that sort of thought process in your investments and in managing your funds.
Yeah, I'll start off. So we're, and I think Direct Capital are the same, we're both signatories to the United Nations Principles of Responsible Investing, and that's got a, some of you I'm sure in the room will have heard of it, it's got what's known as ESG principles, so environment, social and governance. And everything we do in terms of looking at businesses as we invest in them, and then as assuming we do invest in them, what we do with them has that overlying framework, as well as obviously try to increase value of the businesses. So if you have a look at our portfolio, you'll see sustainability and the environment and importance of health and safety, and those things do come through. And each company that we work with is a little bit different. In terms of the things that most affect them from a risk perspective, but very much that's a framework that we very much have at our heart, and it's important also to many of our investors as well.
Yes, It's a big part of business, and it's a big part of life, and it's just crept into investing. And it was actually originally led by the big institutional investors who the first rumblings in this whole area started from them. But what we all discovered in New Zealand, and to a slightly lesser extent in Australia, because they've got a big mining sector in the private equity world, is that we were largely carrying out these sorts of investigations anyway. And if you want to be an investor long term in New Zealand, you can't go doing too many bad deals that are bad in nature. You have to stay reasonably in the mainstream. But probably the best thing that's happened in the last decade is it's actually turned. It's something you should be doing anyway, but it's something that you now have to do. It's turned into dollars and cents. If you've got a bad business, you will be prosecuted by one of the regulatory agencies. If you've got a bad business that infringes these things, the banks don't want so much to do with you anymore. Your insurance premium, you can't get yourself insured. When you look to sell it, the due diligence exercise, all the people go through is quite extensive, and if they discover things, it absolutely turns some people off a transaction, but as a minimum it reduces the valuation they put on it. So it's a good thing, but it's turned into a dollars and cents thing, so everyone does it whether they're signed up to the UNPRI or not, in our view.
Yeah, and I would agree with that in terms of what I'm seeing from an M&A perspective. It's coming through strongly in some of the due diligence expectations of purchasers. They're looking to go work through a checklist and in some cases conduct quite thorough due diligence around these areas, and that's comforting, I think, for all of us. I'm going to jump to these questions because there's quite a lot mounting up. Thank you. The first question is for Dave, actually, and it's got a lot of votes. So, Dave, the floor is interested to hear what are some of the interesting terms and structures in PE deals specifically that you've seen overseas that we're not yet seeing here?
Yep, so we do a lot of work with, Australian and global private equity, who are quite often the people that the domestic private equity funds sell their businesses to. And for those folks, leverage is a really key part of their financial thesis. And I guess in particular for the globals, they sort of get terms in one market and they then look to migrate those terms to other markets. So there's sort of a race to the bottom in terms of debt terms. Not all markets are exactly the same. So there's often a lot of pushback amongst lenders when funds say, hey, we got these terms in this other market, let's bring them to New Zealand, for example. And there's a lot of discipline in the banks to sort of not go down that road. But one interesting, recent feature is the growth of non-bank lenders. So that trend was sort of starting up in the UK maybe 3 or 4 years ago. It's finally made its way down to this part of the world. And it's finally made its way to New Zealand. So, for example, we were just working for an Australian private equity fund looking at a business here. They sort of went out to 6 banks, 5 non-bank direct lending funds, and 5 mezzanine debt funds. So I guess the landscape is shifting. It's not just the traditional banks, although the banks will always have a role to play.
And interested in your comments, Nigel, Ross, about that, the changes that you're slowly seeing, seep over from overseas. Do you see those positively? Or, the New Zealand market is pretty unique in some of those characteristics we protect pretty fiercely in the way we think about things?
Yeah, they're here and they've been here for a while, but you're right, David, it has become mainstream. We don't deal in it ourselves. We're generally borrowing in our businesses under 100 million, and we can do that in one tranche from one bank in New Zealand. That's about the limit for that. But if you're borrowing over 100 million, you're looking at at least a syndicated senior facility. But look, we're looking at growth businesses, and they're changing their characteristics all the time, and therefore you have to change your bank facilities all the time. We've always just found it a lot easier if you can deal with one bank and go back and bilaterally talk about it. I was going to say unilaterally. Bilaterally talk about it with one group. You're just a bit more nimble.
Yeah, I mean, I just echo what Ross is saying. I think both Direct Capital and Pencarrow have a fairly similar investing philosophy. We don't tend to leverage our investments particularly. Obviously, we put a certain amount in there, but we're growth-style investors, so we're really about backing management and companies to grow those businesses, and often you don't want a lot of leverage in there. So, just as Ross was saying, our levels of appetite for debt can all be catered for and have always been until now, and we'll see what happens, but by the New Zealand banks, the main trading banks.
And I think you guys tend to have a longer investment horizon as well with your the businesses that you partner with. So the globals would tend to have a much shorter investment period, so they buy the business, scale it up, leverage it up, and then sell it on in a few years. But I think you guys have a bit more of a longer term philosophy, flexibility in your documents.
Actually, we had a group come in yesterday, an international group, who are funders in the non-bank area. They were telling us the average buyout, which isn't private equity in New Zealand, by the way. We're much more in growth capital mode. But he was telling me the average leverage in the US is creeping up sort of the 8, 9, 10 times in deals. We're supposed to be right across Australia. We were told about a transaction that had 7.5 times EBITDA as leverage in Australia, which is a new high. We'd not heard that before the global financial crisis. Over here, 3 to 4 times leverage is quite high. The stock market has about sort of 2.2 times EBITDA leverage, and I know across our growth funds we've got less than 2 as leverage. So it's a very, by nature, it's a very different beast to private equity offshore. And I suspect you're right, Dave. The non-traditional financiers will be banking the international deals in New Zealand.
That's right, and I mean the biggest deals in New Zealand and Australia are now being financed directly in offshore markets. So KKR just bought MYOB, that was financed in the US markets with those sorts of numbers. Apex bought TradeMe, that was also financed in the US market. So the bigger, at the really jumbo end of the spectrum, those are the markets that will sort of will service the industry. But it's a very different segment to the market than New Zealand private equity.
Cool, thanks Dave. Look, I'm just going to jump back to some great questions coming through. The next one with quite a few votes coming through is, have we missed the boat? Given the high valuations, competition for assets and dry powder, why should one allocate to PE at this stage?
Yeah, I'll have a crack at that first. I think that's all a bit of a myth for New Zealand, to be honest. I certainly in America, you have to wonder whether it's getting a bit over the top in terms of the dry powder. But in New Zealand, I think we're only just starting to hit our straps. And one of the ways I characterise that, it may be that we've raised $1 billion in the last couple of years as an industry, but actually if you look out there, there's more than $250 billion worth of private companies just in the mid-market. So the kind of 1 billion or whatever it is of dry powder is just swamped by the opportunities. And I'm sure it's the same for Direct Capital, but we're just seeing an enormous number of companies that we can look to invest in, and so we can afford to be very selective about it because the opportunity set is so large in relation to the amount of capital that's been raised.
Yes. Can I say that probably the best answer to that question, whoever asked it, is that people who are in private equity are not only continuing to invest in it, they're investing in much bigger amounts than they used to. So, I think you've got to judge an industry by how it's performing for its end investors, and they vote pretty strongly with their feet. But look, to put some other numbers around it, in our segment on the stock exchange, there are 70 companies with turnover over 40 million and are profitable. In the private company market, if you put that category in place, you've got about 600 companies. And so that's just New Zealand, and most of us invest trans-Tasman. So the equation is enormous. And I think going forward, there'll be more money in private equity, there'll be more managers, but it's almost like when we started, the industry's gained so much momentum over the last 20 years. It's now a solution for an increasing number of people. Back in the day when you were a private company owner in New Zealand, you had two options pretty much, and that was to hold your company or pass it down your family or to your partners, or to sell it to a trade buyer. There's now another option in the middle where you don't have to sell it all, and that's quite appealing to a large number of people. The myth probably is that people want to retire, and most of the people that Nigel and I deal with are already wealthy. They're not doing something for the money. They've probably got their 50 million aside somewhere. But they are looking at changing the way they deal with the business. They don't want to be full-time. They want to be a director, or they want to just be involved in one part or another of it. So private equity provides that solution to the private company owners, and I think that will grow. I think people that you hear a lot about the baby boomers selling their businesses. They're not always the people doing it at all. In fact, there's quite a lot hang on to their business in that age bracket. It's the people who are sort of 45, 50 that just want to keep going in the business, probably don't want to leverage up, but have got some big opportunities in front of them, and they're not sellers of their business, but they will take a partner. And so I think that demand side from the institutions to invest in it, and the demand side from the private company owners will continue to grow it. It won't be as big as the stock exchange, but it'll certainly be double, treble, or 10 times the size in 10 years than it is now.
Ross, I completely agree with what you're just saying in terms of private equity being a really exciting and viable option for business owners rather than a complete exit. But what I see day to day when you're working with a private company owner, there's still a massive education process for them. They don't necessarily understand what private equity is and the opportunity that it poses for them. I wonder what we could do as a community to educate medium-sized and small business owners better about that as a potential channel to exit for them. I'm interested. You say, I wouldn't have been surprised at that comment 5 or 10 years ago. I am surprised at it now. In fact, I think if anything, I think people do understand it too well, and understand it primarily in the buyout and leverage cycle. I'd agree with that. But the company, I suppose you just attract groups that are a bit like you, and so the ones that we're in touch with know exactly what's going on, I think. And you're probably doing a lot of that by word of mouth and just direct contacts. And I suspect part of the misinformation that's out there is influenced by some of the big leverage buyout deals that were done 10 years ago, and the headlines that were created by that.
Okay.
But I certainly do see sort of a misunderstanding or a lack of appreciation for the opportunity in that small bits.
Yeah, look, I think the market's becoming more and more educated over time. I think 5 or 10 years ago, when we'd go and talk to someone about their business and mention the word private equity, we first had to explain what those words were. These days, you have to do that far, far less often. I think the other thing is New Zealand, we're a small community relatively. We're less than the size of Sydney or Melbourne. People know a lot of the individuals in Direct Capital. They know a lot of the individuals in Pencarrow via people that we've worked with in the past. Both of us have had long experiences of working with management teams, directors, founders, owners, and driving the value increment in those businesses, and those stories get out there. So there'd be very few people that we come across in New Zealand that don't know about some of the history of some of our portfolio companies. So it makes it a lot easier now that there is some history. A
slightly more technical question coming from the floor here about IRRs, and the question is IRR a good measure for evaluating PE funds, given it can be manipulated so easily?
I would say no, and I'd also say that's not what the institutional investors are looking for. I think you're right. You can buy and sell a company in a reasonably short period of time and create IRR. It's not. Most investors in the private equity area are looking for relatively low risk, long-term assets, so they'd probably prefer a much lower IRR and the volume of money returned to them through dividends and distributions at the end being larger. So I agree with that question. It's not the right measure.
Yeah, I was just going to reinforce what Ross was saying. I mean, at the end of the day, I think people look at both IRRs and multiple of invested capital. You've got to actually look at both to see how well the underlying investments have performed.
Great, thanks. An interesting question coming up here around the link between private equity and IPOs, and the question is whether, as in the picture you painted was a really positive one, Ross, of growing the size of the sector here in New Zealand over the next 10 years. Is that something that could potentially help fuel the IPO market as well, with more listings through the NZX?
Yes, definitely. Look, we all look at it, and we've all got we've all got companies that are on there. We use the companies that we've been invested in as marketing tools for the exchange ourselves, and we've had 3 good ones. We've had Ryman and Scales and New Zealand King Salmon, who have all enjoyed their time on the exchange. It is extraordinary in New Zealand. There is a group of private company owners who don't want to float, but they don't want to on an imperfect fact base, and if you can get through and have that argument, you can knock a number of those over. And so I think, look, listing I think is a good opportunity, and it's a great opportunity right now, because with what's happening in the world, with the political situation, with the OIO and overseas investment situation in New Zealand, and with sort of general nationalism around the world, sort of home capitals focusing on home markets more often than it was 5 or 10 years ago, and that should play well into the stock exchange's hands, in my view. There's just going to be a number of foreign investors won't invest here. Multinationals have always been great buyers of assets. I think it'll always continue on, but I think it will slow down. And mirror that with the stock exchange that's got quite a lot of effort going into having an exchange that mirrors the market, and the market in New Zealand, most of the companies have got turnover of between, say, 100 and 200 million and 20 to 40 million profitability, and a stock exchange in this country will always just mirror what's out there in its community. So I expect that mid-market end of the stock exchange will grow. And actually, I should say, if it's a company with 200 million turnover and 40 million EBITDA, it will be at the top end of the stock exchange, the top half.
Great. Dave, did you have something you wanted to add to that?
I guess foreign private equity or global trade presents a clean exit. I guess there's been a few. Obviously, everyone would have seen the Vodafone deal that was on IPO track for some time, but obviously didn't go down that road. We've worked with a few global and Australian private equity funds who sort of have offered a great, clean, easy exit for domestic private equity. So I guess it really comes down to valuation and whether you're after a clean exit of the whole structure, or you want to stay in there for the long run.
Yeah, look, it's definitely a choice in terms of exit IPO. It doesn't suit all companies, as Ross was saying. But I think also take this in perspective. The NYSE and other stock exchanges around the world are suffering equally. If you have a look at the most recent statistics on exits from US private equity firms, I think it's less than 5% go to IPO. It's a huge, the issue over there's such a huge private equity market now. You get transactions just being between private equity firms and continue to stay between private equity firms. But this will change. We're going through a phase at the moment, but I think, as Ross was saying, there's no reason we can't have a better IPO market at some stage in the future.
Hey, given what we said before about very few people want to retire and lots of people want to continue on with their business, the stock exchange offers exactly that solution to company owners. And your original question is, how should we change the way we front these potential listing entities? Probably that, I'd say.
Another great question coming from the floor, and it's sort of linked to the discussion that came before us around VC, and they're interested to know how you would personally define the difference between VC and PE in the New Zealand context. And maybe go to you on that one, Nigel.
I'll have a crack. Look, the area has certainly become greyer as more and more, and this has been led out of the US, private equity firms become interested in software and technology. It's become, I think it's actually now the favoured space if you ask private equity firms in the US. So it's a question of where VC ends and where private equity starts. I think from our perspective, we like technology and software. We've invested in a number of companies in our two most recent funds. But we like to make sure the businesses are, at least if they're not profitable, have a very clear route to profitability and have an absolutely established business model and already have a market and go to market. I think what venture capital firms are happy to be at an earlier stage than that. So I kind of think it's the definition's slightly grey, but that's kind of where it starts and ends.
Any other comments on that, Ross? A good question that's coming through at the bottom, which is one of the questions that I had noted anyway, was slightly different structure. Why don't you list a PE fund so that individual investors and KiwiSaver can get access to the private equity sector? What's stopping you from doing that?
That's a question for me. Look,
Any of you?
There have been examples, obviously, for the very, very large private equity firms, the Blackstones, the KKRs and so on, of them listing, and it's largely driven by succession requirements as the next generation's looking to grow and the older generation's trying to work a way out. But unless you've got that conundrum in front of you, there's really not a lot of reason for a private equity firm to list. Just as most of you that belong to fund managers, there's no listed fund managers. So there may become a stage at some point where there's intergenerational requirements, but I can't see it in the near future.
Could I answer that a slightly different way, because it's topical at the moment. There's a committee set up to look at how to promote the capital markets in New Zealand, and the stark thing about that is, our banks are largely Aussie banks or offshore banks. Our funds managers, we've got one listed bank. Our funds managers are largely private entities. Our stockbrokers are largely private entities, and why have we not got financial assets on the market? It's a very good question, and one that's being looked at right now. But one reason I would say that they're probably not listed is one big opportunity the exchange offers you is growth capital. And of course, none of these businesses outside the banking sector need capital. They're all businesses that create capital. They don't consume it. They've got very good recurrent incomes and profitability. So that's one reason. But it's a great question. I hope it's not asked this time next year, because there's work going on.
Great. Another question that's sort of comparing the New Zealand sector to some of the international funds, so perhaps one for you, Dave. How can the local private equity sector compete when the global cost of capital is relatively so low?
I guess they traditionally operate in different segments of the market. So, we go to Oz regularly and talk to global funds that have operations there about deals in New Zealand, and they say, step one is, what's the minimum check size for a deal? And then they say it's X 100 million, EV business, and then we scratch our heads and think, how many opportunities are there at the moment in the market of that check size? So I guess they're operating in different segments of the market, so their paths probably don't cross other than New Zealand private equity selling to Aussie or global private equity at the moment. The New Zealand industry will scale up, and potentially there will be a bit of overlap.
Another area that I think that they compete, or an advantage they have, is just the local factor. So New Zealand businesses like working with New Zealand private equity, there's a cultural similarity, there's personality fit, and often working with an Australian or a global private equity fund comes with a different change in culture and a different expectation. So I think that's a huge advantage that these sorts of funds have.
I think Dave's right. We don't now and are unlikely to compete in the future. In the growth capital part of private equity, which we're both in, we do, but there's real differences. Both of us manage open-ended funds, and so you can offer to invest with management for 20 years if you want to. The real difference is when it comes to the actual transaction the private company has to do with the fund from Aussie, where there's a mandated sale contract in that clause in that contract, and it's whether the private equity fund own 40 or 80% of the business, the private equity company gets to control the exit, and they need it because it's a term of their own funds. So we've done well here in New Zealand to be able to manage long-term funds. If anything, our time horizon is set much more by either the age or the willingness of the current owners and managers to carry on, rather than our own, any drive from our own side. So it's it's a very different solution that we all offer, and those three solutions we just isolated there are all appealing to different people in the market. So we sort of cross over remarkably rarely.
Yeah, and I think Ross is right. It's the way I think about private equity, it's not just capital. That's probably almost the minor component. It's people. And so these business owners and founders and CEOs are actually looking to who am I partnering with to help me with this next level of growth. With trying to deal with someone overseas, it's that much more removed. The other thing is those overseas companies tend to be bigger, and therefore their minimum check size is quite a bit larger than us. So in some ways they're complementary to us in the ecosystem.
Look, I think we probably got time for a bit of a wrap-up from each of the panellists, but I'm conscious there are lots of questions here that I haven't got to. I'm sure these guys will be around afterwards to follow some of them up, but I'll just finish on one quite broad question, which I think is an interesting one, and ask you each to address it. So what are some of the wider opportunities you think may be being overlooked or not yet fully taken advantage of in this space? Ross, going to put you on the spot first.
Off the cuff, I don't know, but I don't know if any of us are thinking about that. I think we're like coal miners, where we follow a seam, and the seam is quite long and quite wide. So I think most of us are trying to do more in the same channel as we're in now. I'd be surprised if any of us are looking outside to say what else should we be doing. I think we're running quite hard to keep up with what's in front of us. I don't know if that's an overly rosy view or not.
No, I was thinking the same, Ross. I mean, in many ways, we've got the wealth of abundance out there in terms of opportunity sets, and I think that the challenge for us is actually saying which ones do we filter out. I think it's on average, if we look back at our entire deal pipeline, I think we execute 1 in every 40 opportunities we look at. So we're very privileged to have such a wide set of opportunities and so little competition in our market.
Any comments, Dave?
I think it's just an interesting perspective, because you often hear in the media, well, there's so much dry powder chasing so few deals, but talking to Nigel and Ross about the way that they have analysed their segments of the market and the number of potential private companies out there that would be good candidates for them, it's just a really interesting perspective. So what you commonly think about, it's actually quite different, the opportunity that's out there versus what you might think about in the media.
Actually, can I just say one? There is one that a lot of people in our position do diversify into, and that's running a debt fund alongside their equity fund. We're not looking at it and don't think there's a need for it in our business, but it is quite a natural fit. There's a number of private companies out there that need shorter term capital. Sometimes debt suits that. Sometimes the shorter term facility isn't as attractive to the banks, and sometimes it's got a higher risk component. So groups like us do look at those funds and run those debt funds reasonably well. And one of the advantages that the synergies between us is if a bank lends that money that's slightly out of their normal criteria and it defaults, that's a problem. If the groups like us lend the money through their debt fund, you convert it to equity, it's the solution, and it moves into the equity fund. So that's one possibility, I would have thought.
Yeah, that's a big growth space. So all the global funds now have big credit platforms. It's quite interesting working with a private equity fund who now has that on their menu as a financing solution, and they think, hey, you know, we know how smart these people are at XYZ global private equity fund. Do we really want them to be our lenders? Maybe we'd prefer to have banks fund us, but there are, of course, assets that don't fit into buckets that banks can fund. So they're definitely presenting a solution and will be more visible in the future.
Cool. Look, I'm conscious we've got a big red flashing light shining at us over here, and I'm also conscious we're standing between you and lunch, but hopefully you found this an informative discussion. I think if you're quick, you might grab these guys after as they're walking out to ask those questions that I didn't get to, but thank you for your attention and thanks for the opportunity.